we're seeing Bitcoin allowing people to think about capital differently, preserving capital differently, and spending capital differently. And now we're seeing all of that collide. You can't raise so much that your entire vision of the business that you're raising gets sidetracked and you lose control through things like board seats, liquidation preferences, etc. And if someone wants to raise capital in the modern world, they have to also layer on the fact that they have to consider runway, growth projections, revenue in a Bitcoin world, both in terms of expenditure and also their Bitcoin treasury and what that does to their runway. Capital formation is all about exactly how you're planning to raise money and deploy that money, and that bleeds right into capital preservation. Almost every single founder to a T that is Bitcoin savvy, the first question they ask is, yeah, what about Bitcoin treasuries? And I think that's going to be a real big shift in the private capital markets, where you think about Bitcoin treasury as part of the capital formation process.
You buy Bitcoin, you hold it for more than 4 years, Joe. That's my advice to everybody.
Fair to say you simply flooded the system with money?
Yes, we did. That's another way to think about it.
Where does it come from? Do you just print it?
We print it digitally.
I'm very bullish on the long-term viability of Bitcoin.
I was going to say, did that surprise you?
That surprised me how much that's gone up.
Hey Internet, welcome back to another episode of New Foundations, the podcast brought to you by Acropolis, the Bitcoin treasury company. Back in the studio, as always, with my co-host, co-founder, and CEO of Acropolis, Chase Palmieri. And this week we are joined by Dr. Arman McGorian. He's the founder and CEO of Timestamp, also known as Dr. Bitcoin MD on X. And we're really excited to have a conversation about what they're working on at Timestamp and announce a partnership between Timestamp and Acropolis. So Arman, welcome to the show. I think this is your first podcast, if not one of your first podcasts, right?
I've had the pleasure to do a few, but I would say this is probably the most monumental in terms of the announcements we're making, for sure.
Nice. And Arman, obviously yourself, myself, and Mason, we all have kind of startup background experience ourselves, but Timestamp works with a broad set of Bitcoin native startups. And so I'm curious if you can take us kind of all the way back to this moment in time where the idea behind Timestamp was maybe only half baked, and you're looking at the ecosystem around Bitcoin native startups and their need for fundraising infrastructure. What was that really early kernel of an idea? What was it that clicked for you? Take us all the way back to just that little aha moment that eventually became kind of the solidified Timestamp that we know today.
Yeah, so I will say, as you guys have probably experienced at Acropolis and any founders listening have experienced, there's usually multiple aha moments along the way, but I will say the spark came at a very particular moment in time. So for those that don't know, my background is actually as a medical doctor. That was my previous career. Eventually, the hold of Bitcoin just overtook everything in my life, as it does with most people. And I decided to pause my medical career. This was now 5 years ago, to be working on Bitcoin. And at the time, I didn't know exactly which direction that was going to go in. It's really hard to be a trained medical doctor and try to work in Bitcoin. Not many roles really for clinical practitioners. Although I will say there are some health-related startups now that didn't exist a few years ago that are really interesting. But at the time, I wanted to just learn as much as I could and be involved. So I actually quit my career, dropped everything and moved to Austin, Texas for a bit, and got a chance to interact with a lot of people that were building things. And what I realized was, number one, these people were some of the brightest people I've ever had a chance to meet. And I say that as someone that has a career in medicine, that has a career in academia, and dealing with fairly intelligent people throughout my life. These are by far some of the smartest people I've ever had a chance to meet. And what I realized was these people were attempting to work on some of the most pressing issues of our time, which, when it comes down to it, is a lot of times boiled down to the money and all the tools that you build associated with the money. And I had a chance to explore so many different things. I worked for companies that were more tech-focused, hardware-focused, and then I also did some work with Bitcoin mining companies. When I was working for Bitcoin mining companies in particular, I found this huge gap in the capital market side of things. A lot of people that understood the opportunity in the markets, and a lot of people who just wanted to be involved but couldn't get involved somehow. So I started looking at the capital market side of Bitcoin, and when I started floating around these ideas, um, people that were building in other sectors of the Bitcoin space in particular, so hardware, software, wallets, what have you, all had the same issues with regards to capital markets. And so it made me start thinking about the capital markets infrastructure in general and how the landscape was changing. So if you think about capital formation side of things, startups raising money, the last 30 to 40 years has essentially been dominated by uh, what I'd call the natural fiat fallout. When the money is broken and money is cheap, you have a lot of Silicon Valley mania, a lot of crazy valuations, a lot of VC involvement in companies, and a lot of distortion in the markets in terms of value creation. And it was a polar opposite compared to what I was seeing in the Bitcoin world. I saw a lot of builders that were thinking more long term rather than quarters, thinking decades, rather than um, their balance sheet for the next month and their runway for the next 6 to 12 months. So it was a very interesting thing to try to work within these markets, but consider what these Bitcoin native companies were doing. And so that really gave me the impetus to start Timestamp and think about what capital formation and capital markets really look like on a Bitcoin standard. And lo and behold, 4 or 5 years later, I'm here talking to you guys about Bitcoin and capital markets and getting to work with your wonderful team at Acropolis.
That's a great segue. Our next question is, how does Timestamp see the future of private capital markets as the traditional financial world and the Bitcoin economy collide?
So there's a few ways I can take this, but I'm just going to touch on a few points. I think we're at an interesting transition period. We're going to see a lot of things occurring at the same time, and some of it might be incongruent. I think it's going to be the fumes of the fiat system and the start of the Bitcoin system and an overlap of the two, which is where you're going to see some of the confusing, opposed signals that are coming out. So you're seeing right now in a lot of the traditional VC and capital markets, several billion-dollar valuations for some of these startups, and some of them haven't even produced a single thing yet. It's just a name brand only. Maybe it's a known founder, or maybe it's a hyped product, or what have you. And I think that kind of stuff happens at the end of certain cycles, at the end of the fiat cycle in particular. But what you're seeing on the other side of it is actually where Bitcoin comes into play. When you have founders that are actually Bitcoin savvy and understand the value of Bitcoin and think in Bitcoin, it's very much like individuals, where you see the adoption of Bitcoin as a store of value first, a medium of exchange, a unit of account. A lot of founders are starting to see Bitcoin as that store of value on their balance sheet. And they're starting to think about their raises in terms of Bitcoin and their spending in terms of Bitcoin. So two things that I've seen with founders, especially the ones that are building in the Bitcoin space and are already very savvy with Bitcoin, are they're raising less than they would have just a few years ago because they're already planning what they're going to allocate to Bitcoin and how they want to save that capital. And so they're raising a lot less than they would have. And two, they're spending a lot differently than they would have. Instead of just spending for the sake of growth, they're really thinking about every decision they make in terms of capital expenditure. And you're seeing some of this in the fiat markets, but it's without the understanding of Bitcoin. So for example, you're seeing a lot of companies have very high valuations or very high revenue numbers per employee. And that's because of a lot of capital compression. So one other thing that's being thrown into the mix here is AI as a tool for a lot of founders. So we're seeing AI compressing capital needs and allowing people to operate more efficiently. And then we're seeing Bitcoin allowing people to think about capital differently preserving capital differently and spending capital differently. And now we're seeing all of that collide. And that's where really I think what we're building at Timestamp and what you're building at Acropolis come into play, because we get to be on the frontier of these capital markets, and we get to interact with founders that are thinking about where the puck is going and really how to think about these capital markets while they're building the company for the future.
Yeah, it's a really good point. When you think about the role of Bitcoin as kind of your treasury capital that extends runway over time, and then AI, which, can theoretically lower headcount while improving efficiency and scaling up operations, you really start to see a world where the 4 to 6 to 8 person startup can really be a player on pretty much any level. And when you're talking about startups running on a Bitcoin standard and kind of treating Bitcoin as a hurdle rate, I guess I'll share kind of some of my thinking here. Obviously, you could come at it from first principles and say, well, you should raise as little capital as possible for what you need to get to profitability, and then grow the business from there. That way, you're diluting ownership as little as possible. You're not over raising, and you're focusing on providing value, and then capturing revenue in Bitcoin terms and growing that Bitcoin per share. But then the other side of me as the Bitcoin operator is thinking, yeah, but Bitcoin will be worth more in the future. And if I can raise as much equity capital today and park it all in Bitcoin because I don't need to touch it for operations, and basically run the strategy playbook to some degree by, allowing for some equity dilution, but in a way that increases our Bitcoin treasury, that also is arguably the Bitcoin maximalist position. So before we, this one may be a little off topic here, but I think it's worth thinking about. Is one of these to you more first principles than the other? The idea of just raising as little as possible versus raising as much as possible?
So this is an excellent point, and why I love working with you guys is you guys think about this all the time, right? From a Bitcoin treasury standpoint, and we think about it all the time from a capital formation standpoint. And so I think what you brought up is an excellent example of the challenges founders face nowadays, especially if they're understanding of where Bitcoin is and where it's going, which I think a lot of founders are starting to understand very quickly. It's an equation of dealing with Bitcoin versus time versus equity and control, right? There are three factors that are floating up in the air, and the balance that founders have to strike is that they should be able to raise to a point where they can keep control of their vision of their company, but still allow for the flexibility to have a relatively decent sized Bitcoin treasury, because they understand where the puck is going. So when I say that companies might be raising as little as they need, that does ignore that other side of the equation. It's like, well, if you could raise a little bit more and park that in Bitcoin, is that a viable strategy? And I think the answer is absolutely yes. So this is the balance that I think modern founders have to strike. Is you have to raise enough where you feel like you have a runway to hit your milestones. You have to raise enough where maybe you can build a decent sized Bitcoin treasury and take advantage of that upside. But you can't raise so much that your entire vision of the company that you're raising, of the business that you're raising, gets sidetracked and you lose control through things like board seats, liquidation preferences, etc. So it's a very fine balance that you have to strike as a founder nowadays. And I think Timestamp working with the team at Acropolis really gives founders the best possible chance of figuring out exactly what that balance is.
Embrace the future of corporate finance with Acropolis, your strategic partner for a Bitcoin treasury strategy. We're the experts your business needs. Acropolis offers trusted Bitcoin advisory. We provide you with an outsourced Bitcoin strategy officer, world-class research, and a creative financing team, and more, so you can navigate Bitcoin's market with confidence and acumen. Best-in-class custody with multi-institution custody. Eliminate the risk of loss while maintaining full control of real Bitcoin. Acropolis exclusively uses multi-institution custody as the safest and easiest way for businesses to hold Bitcoin. Bitcoin-only solutions. The Acropolis platform is designed for businesses of all sizes to seamlessly manage their Bitcoin treasury, and we focus solely on Bitcoin to offer you the most specialized services available. Adding Bitcoin to your balance sheet is just the beginning. With Acropolis, you're not just adopting Bitcoin, you're mastering its strategic use to create and maintain value for generations. Take the first step and start your corporate Bitcoin journey with Acropolis. Book your free consultation today at acropolistreasury.com/book and start implementing our proven strategies within days.
Yeah, I think that's an excellent point. The equity dilution is acceptable only up until it becomes a problem for the executive team to have control over the vision and the operating business. So that's a really good point. So practically speaking, let's just ground the conversation a bit here. How does Timestamp actually provide capital formation for startup founders? What does that process look like, and what makes your approach unique?
So I think when you think about a founder building a business, first off, just building the business alone, they have to wear a ton of hats, as you guys are sure, I'm sure are aware, and any founder listening is aware. You do things that you never thought you'd have to do on the tech side, on the business side, accounting side, etc. And there's a lot of plates that have to be spinning around the same time. And all the while, you also have to be thinking about your balance sheet, your revenue, your growth, your targets. And a lot of times in the startup world, you have to think about raising capital because oftentimes it requires some capital to get to a point where you can be profitable, or you might be trading capital now for growth, which would increase a valuation of a company down the road. So most startups, and not small businesses, I'm talking specifically startups, will have to raise capital at some point. And so when they go through that process of thinking about raising capital, there's a lot of things that they have to consider. What terms am I using? What financial vehicle am I using? Who am I going to actually try to raise that capital? And once I do talk to people that are aligned, how do we agree on these terms? How do we settle the terms? How do we make sure that we protect ourselves as a company going forward and not make mistakes that could be killer down the road? And I've seen that happen so many times with early companies, great teams, great ideas, is early mistakes that kill the company in, 3 to 5 years, and it's just a ticking time bomb. So when it comes to companies raising capital, they really have to consider all these different factors when they raise capital. And if someone wants to raise capital in the modern world, they have to also layer on the fact that they have to consider runway, growth projections, revenue in a Bitcoin world, and think about exactly what that looks like, both in terms of expenditure and also their Bitcoin treasury and what that does to their runway. So thinking about how we built Timestamp, we really wanted to take a few approaches as first principles. Number one, when you look at the traditional investing world, you look at the VC world, it tends to be very exclusive, and it tends to be exclusive for a reason, and a lot of that is regulations. So if you want to participate in a VC investment, oftentimes you have to be an accredited investor. You also tend to have to write very large checks, at least large checks for the average person. You essentially give up a lot of the control in terms of what you invest in. You're trusting someone else to invest on your behalf. And their job is to do so, is to be a capital allocator. And some people are perfectly happy doing that. And that is great for a certain amount of people. However, there's a lot of people in this world that want to be able to participate in startup investing, but they don't have the opportunity either because they're not accredited investors, or they just don't have a large enough checkbook to really participate. So one of the first principles of Timestamp was to maximize the access to the space. So Timestamp is a registered funding portal with the SEC and FINRA, which allows us to bring in retail investors, so non-accredited investors, that can invest in offerings with as little as $100. So the average person gets to participate in these startup investment offerings, and they get all the information that a VC would. So they can look at a company's financials, they can look at their entire offering, who the team is, what their business goals are, what their projections are, and they get to make a decision for themselves. Now, principle number 2 is a lot of the modern startup investment platforms are very fiat focused. They are not building for a Bitcoin standard. They're very much focused on the fiat world. So we're really focused on building the infrastructure for a Bitcoin world. And that works on both sides of that business. So one side is investors and the other side is founders. For investors, it's giving them the tools to use Bitcoin for investing and also stable coins for investing, because these tools are very useful for people that might not have traditional banking accounts and they don't have access to traditional systems, but they might have access to these monetary resources that weren't available 10, 15 years ago. And then for the other side, for founders, it's building all the infrastructure for a Bitcoin world. So it's being able to accept Bitcoin, being able to have an on and off ramp, being able to build a Bitcoin treasury with people such as yourselves, and being able to plan out exactly what their startup outlook looks like from a growth perspective, but also from a capital management perspective. And it's really giving them the tools to operate in a modern world. And so when I look at building Timestamp for a Bitcoin world, I really think about both sides, both investors and founders, and think about exactly how Bitcoin can unlock all these different things that we just haven't been thinking of in the fiat world, and really pushing everything forward when it comes to the private capital markets.
And since building Timestamp, what is something that has stood out as the most surprising lesson, that these Bitcoin native companies are facing today?
So this is something that I had assumed would be a challenge, but it really became clear to me as I was building Timestamp, and that's the crossover between the world of traditional finance and Bitcoin. And so if you're someone building in the Bitcoin space, I think at some point or another you're going to run into this issue, and this problem is that everything that you currently interact with on a day-to-day basis, for the most part, is built for the fiat world, right? All these rails, all these payment rails are built for a fiat world. And so all of a sudden, if you're building on Bitcoin, all the challenges that you have as a typical founder are just turned up to 11, right? Because in addition to all the challenges you have building, you're layering on the fact that you're building on this innovative technology and network that is still nascent in the eyes of regulators and the traditional banking system. So I think there is a Bitcoiner worldview, which I partly subscribe to, is that you can continue to build a lot of these systems in parallel forever, and eventually you'll be able to break through and create these wonderful second and third order effects by building fully on Bitcoin without actually interacting with the traditional banking system or the traditional regulatory bodies. And that can work for some things. I don't disqualify that. But I will say, take Timestamp as an example. If you're planning to work with securities, I highly recommend trying to work with the SEC. Otherwise, you're in a world of trouble.
That is financial advice.
Yes, I will say that is professional advice that you should probably follow. If you're going to work with securities, you should expect the SEC to come knocking on your door at some point, especially if you're not doing things by the rules, right? So let's play this out, and I could use Timestamp as an example, right? I think right now we're seeing an interesting flashpoint in Bitcoin's evolution, where Bitcoin is clearly entering the corporate world. Bitcoin is clearly entering institutional capital, but there needs to be a bridge between traditional finance and the Bitcoin world, and there needs to be several bridges. So earlier this year, I went to a conference in New York. It was a Bitcoin for Investors conference. I think it was Anthony Pompliano's put it on, and it was an eye-opening conference because it was one of the first Bitcoin conferences I've been to in my life, and I've been in the space for over 10 years, where I walked into the room and it was all suits. I mean, 95% suits and ties. And this was a real game changer for me because most of the time you go to conferences and it's hoodies and t-shirts, right? It's great conversations, brilliant people, but hoodies and t-shirts. And this was a game changer and an eye opener for me. And they might still be the cowboys of Wall Street, but their Wall Street is here. And I think what's important to realize, and I've said this earlier this year, is the bridges are being built, right? The question is who's going to build those bridges, right? Is it going to be people from the Wall Street side, from the traditional finance side that are building the bridges to Bitcoin? Or is it going to be the Bitcoiners that realize there are certain domains here where you have to be able to build within the rule set that's given and then push the rule set with the tools that you have in Bitcoin to be able to nudge the world in a certain direction, right? And I think this is where timestamp really plays, is we are really a bridge between the traditional finance world of securities and the modern world of Bitcoin. And we hope to be that bridge that connects the two and gets to be the pioneers as pushing this field forward. And so when you ask the questions about building on Bitcoin in particular, I think it really depends on what type of subdomain you're operating in. But I encourage a lot of Bitcoiners to really think about the implications of what the moment is that they're living through and whether they want to be the ones leading the charge or they want to sit back and watch the people that are in the traditional financial world that essentially got us to this point. Do you want them to take charge of this thing? So I hope Bitcoiners listening will understand that they have an opportunity here with the knowledge and the wisdom and the resources at their disposal to actually build great things and effectuate change while still doing things in a somewhat traditional fashion.
Couldn't agree more. I mean, it's the easiest it's ever been to start a company. Not that starting a company is easy, but in terms of the information, resources, tools, it's easier than it's ever been. And once these Bitcoin native companies have raised the capital, you'd imagine that they would want to hold a significant amount in Bitcoin to extend their runway. You know, these are things that we've discussed, avoiding future dilutive fundraising rounds. But what have you been hearing from your current clients and their interest in a Bitcoin treasury with, you know, all the capital that they're recently raising?
So I have a central, one of my central thesis, and I'm sure you guys probably agree, is that I believe every company is going to be a Bitcoin company. I think that is inevitable. The question is, what does that look like? If you think about Bitcoin for individuals, it's very straightforward how that plays out. First, it starts as a store of value. Eventually, you might start using it as a medium of exchange once you feel like you have a reason to, or you possibly get incentivized to. But eventually, most Bitcoiners as individuals start using Bitcoin as a unit of account, and they really plan a lot of their purchases in terms of Bitcoin. Now, when it comes to startups and companies in general, I think there's two sides of the coin here, which really makes this partnership really special, is capital formation and capital preservation, right? So capital formation is all about exactly how you're planning to raise money and deploy that money. And that bleeds right into capital preservation. How are you spending that money efficiently? How are you holding the money on your balance sheet? And how are you really planning the next stage of your company? And that's going to really roll right into your next capital formation phase. Most companies raise more than once. I would love to be in a world where companies don't have to raise as often, or maybe they raise once and never again. And I think that's the dream outcome for a lot of founders. But money ends up being a great tool to build faster, to grow, to hire new people. Becomes a great competitive advantage. So I don't think raising capital is just going to disappear overnight. I just believe the framework that we use to think about raising capital is going to change, And the leverage is actually going to shift more towards founders because they have more tools to raise money. They have better ways to preserve it. And they'll have a different mindset when it comes to negotiations with a lot of these capital allocators. So when it comes to founders that come to us at Timestamp and think about capital formation, I will say almost every single founder to a T that is Bitcoin savvy, the first question they ask after I give them the rundown of all the different services Timestamp offers is, yeah, what about Bitcoin treasuries? We really, like, once we have the money, we really want to think about, how we hold it, how we custody it, how we're going to spend it. And I got that question so much that that's what actually prompted me to reach out to you guys.
So let's do it. Why don't you do the honors, Arman, and officially announce today's big news?
Well, today I'm very excited to announce that Timestamp has partnered with Acropolis to create what I think is going to be the future of private capital markets infrastructure. We are combining capital formation with capital preservation to give founders the best tools to raise and preserve capital in a world on the Bitcoin standard.
All right, so we have a press release coming out right after this that is titled "The Bitcoin Treasury Playbook Breaks Wide Open. Acropolis and Timestamp empower startups to run the strategy playbook without Wall Street access." This is very exciting. Excited to be working with all of the companies that are listed on Timestamp and working with Timestamp. Like you said, this is bridging both capital formation and capital preservation. So it's, I feel lucky to be a part of a cool partnership like this. How does this partnership redefine Bitcoin treasuries as a strategy accessible to startups, not just large corporations?
Well, I think this is a really timely question, and I'd be curious to hear your thoughts on this as well. We've seen a lot of public companies now popping up left and right talking about Bitcoin treasuries and essentially using that as a platform to market themselves as the next Bitcoin treasury company. And to be quite honest with you, I feel like they're playing the cards that they're dealt, and I would assume a lot of Bitcoin savvy founders and companies in their situation would do the same, right? The incentives make sense. You're trying to allocate as much capital as you can to Bitcoin because you believe that it's going to outperform any other resource on your balance sheet and give you the best chance to succeed into the future. And by doing so, it would increase shareholder value theoretically. So the incentives make sense to me. I guess the question I would have for a lot of these public companies is, when does the hype around Bitcoin treasury companies dissipate to the point where we actually start thinking about these businesses, the underlying businesses themselves, and not just the press release about a company buying 1,000 Bitcoins? And I think this is where things get really interesting in the private space, because a lot of these companies that are building Bitcoin treasuries in the private space have a productive business that they've started with and are thinking about adding a Bitcoin treasury on top of that, rather than the reverse in a lot of these cases of companies that don't have necessarily a great business, but they might be sitting on some capital, or they might be able to raise some capital through public markets. So I think there might be a slight disconnect here in terms of some of these companies in the public space raising capital for the sake of building Bitcoin treasuries versus some of these businesses that are producing a ton of value in the private space in particular that are building Bitcoin treasuries. I'd be very curious to hear your thoughts on this.
Yeah, I'll share some of my thoughts there. And I've spoken to this before, but I do think that the marketing boost that a company gets by announcing that they're going to buy Bitcoin for their treasury is already starting to wear off. If you have companies that are literally doing it every other day now, it's just not as newsworthy. It doesn't make it on in front of every Bitcoiner's news feed the same way as when it was MicroStrategy and then Semler and then the next few, and it was just such a earth-shattering, new trend. Now this is kind of an established, way of going about business. Like you mentioned earlier that every company will be a Bitcoin company. Maybe I've swallowed one too many orange pills, but when you say that, I basically hear every company will be a money company. I mean, to me, Bitcoin is becoming the new form of store of value, the new money, the new medium of exchange, especially in a digital world. So it's almost like saying every company will be a money company. Yes, sooner or later, every company will be a Bitcoin company. So that's kind of my thoughts. Maybe I'll let Mason share some of his, or maybe on the partnership more broadly, and then we'll dig into this partnership and how it works in more detail.
Yeah, I mean, there's an arbitrage that exists today for firms that are early on the Bitcoin treasury strategy. They're going to see outsized returns versus getting in the game 5 years from now or 10 years from now. But ultimately, agree with both of you in that every company will end up becoming a Bitcoin company or a money company, just like every company is an internet company and a media company. And things that if you were to set this in 2001, it wouldn't have made too much sense. But I think if you'll say this in 2031, it'll make a lot of sense. And at the end of the day, it is sort of a cheat code. But as you say, and you're great for saying this on X, is you have to focus on a core, healthy operating business and not just rely on Bitcoin to do everything for you. And that's what we preach at Acropolis. I mean, it's not just you adopt Bitcoin, you put out a few press releases, and then boom, your MicroStrategy, boom, you have tens of billions in equity value. It's something that is a long process. It's a long commitment, but those who are early will see outsized returns.
Yeah, and we get a lot of companies coming to Acropolis that are in dire straits, and they basically see Bitcoin as the Hail Mary. And they come to us and they say, hey, you guys are Acropolis, you guys are well known in the space. You offer support when it comes to debt or equity capital to buy Bitcoin. And we're at the point where the operating business is stalled out on growth. We didn't hit our milestones for this last round, and so we can't raise the next round. Our investors basically won't even return our emails at this point. So it's either Bitcoin or close up shop. What can you do to help us? But unfortunately, the reality still is that you have to have an underlying operating business to raise the debt or equity capital. If a lender of capital does not believe that you can service the debt with the revenues from the operating business, you are not going to receive that capital, and you're especially not going to receive favorable terms on that debt. If you want to raise equity capital, you're basically asking someone to be a participant in the upside of that business with you. And again, if your business is failing and struggling and looks like it's on its last life, it's going to be hard to attract equity capital, because especially if the idea is that you're going to do a Bitcoin treasury, because on the other side of that transaction is a private investor who understands that Bitcoin is the hurdle rate, and that rather than take this operational risk, this execution risk with this startup that is not looking like they're in good shape, they could just buy Bitcoin, or they could go into the public markets and buy a healthier operating business. We do get a lot of companies that come to us and almost expect us to be miracle workers, or for Bitcoin itself to be a miracle worker for their business. And unfortunately, a lot of these companies are getting to us too late. And so what I'm super excited about with this partnership with Timestamp is Acropolis can get there and Bitcoin can get there to the company very early on in the life cycle, before they've drained their runway to the point where they need to make this Hail Mary. They can have Timestamp and they can have Acropolis as these partners that help them understand, hey, maybe this is how much you want to raise, or hey, maybe this is the proper allocation to a Bitcoin treasury, so that you never have to worry about stalled out growth for a year or two. You never have to worry about how something like a COVID pandemic might affect your business over a 1 to 2 year period and maybe put you out of business, because you could always scale down operations, sit on the Bitcoin for a couple of years and come out of it and go after whatever revenue streams, whatever growth opportunities exist in that new world. So Arman, to this point, why don't you walk us through the actual kind of user experience that a company might expect when they, kind of start to finish. So they're engaging Timestamp for the capital formation aspect, and then on the other side of that, they begin to perhaps engage Acropolis for their custody of the Bitcoin and tack us on as this outsourced Bitcoin treasury team. What should a company or a startup that's considering, having this tag team support from start to finish, how does that look like for them?
Absolutely. So when it comes to raising capital in general, there's a lot of different factors you have to consider as part of the process. And that becomes amplified if you're going to do it via certain routes. So if you're going to raise funding via equity crowdfunding, for example, and you want retail investors to get involved, you're going to be under a magnifying glass because startup investments are already inherently risky. And then you add retail investors to the mix. You want to make sure all your T's are crossed, all your I's are dotted, and that requires work from legal, work from accounting, work from marketing, and all of these things can be particularly daunting if you've never done it before. So what Timestamp really does is once a founder comes in and we figure out exactly what they're thinking in terms of their upcoming raise, we set them up with a dedicated paralegal and an attorney that reviews all their offering documents. We set them up with an accountant that reviews their financials. We set them up with a marketing team that gives them the best chance to succeed in marketing their offering. One of the few amazing benefits of raising in public via an equity crowdfunding round is you get the chance to market your raise, and that is such a huge advantage. So in addition to the capital that you're raising, you get the chance to get some brand visibility and awareness, and then also creating a compelling offering, creating a campaign page, a pitch deck, materials that really resonate with investors. So there's a lot of things to think about when you're actually going through this process. And if a founder comes through Timestamp, they get support with all of this, and they can go from zero to fully up to date and launching a campaign in about 4 weeks or less. And that's the kind of support that we intend to provide with founders that come to us and want to raise capital. And now here's where the interesting part comes in with Acropolis. Now we've had a chance to discuss this privately, but I'm very excited to talk about this with your listeners. Is now these companies, these founders get a chance to think about their Bitcoin treasury strategy during their capital raise. So it's not something that they have to put off until after the fact. They can actually get started on thinking about their Bitcoin treasury strategy as part of their capital formation process. And they can include that as part of their raise and let investors know that we're trying to be responsible, forward-thinking founders that are not only raising capital from investors, but we're going to allocate some of that capital to a Bitcoin treasury, and we're being advised by Acropolis, and Acropolis is helping us manage that Bitcoin treasury. And I think that's going to be a real big shift in the private capital markets, where you think about Bitcoin treasury as part of the capital formation process.
It's such a beautiful handoff, right? Because you all get to help the company with the capital formation. And then once the capital exists, and I, as to your point, ideally even beforehand, because Timestamp is openly, letting your companies know that Acropolis is going to be ready to kind of catch them on the other side of that. And we can actually come in and be part of that discussion earlier on. As soon as they've raised that capital, they don't have to guess how much of that should go into Bitcoin and do what a lot of companies that try to go about the Bitcoin treasury strategy on their own end up doing, which is becoming a forced seller in a down market because they over allocated, or maybe they see their treasury dwindle away because they under allocated and they're losing purchasing power because they're holding it in cash. So they immediately get to be handed off from basically Timestamp to Acropolis. And it's like, hey, now that you have this capital, let's protect it with best-in-class execution, the right position sizing, the right custody. And by the way, now that you're going to be kind of holding Bitcoin on the balance sheet, there's all sorts of tax and accounting implications. And everything that you mentioned about how you provide that support and you kind of create this streamlined, seamless process on the capital formation side, we can just move them right down the escalator through Acropolis and continue that relationship on the Bitcoin Treasury side. And, we joke about this on all the calls that led to this announcement, but it is so rare that you have such a clean handoff, a clean, we do X, you do Y kind of partnership. And it's really going to be beautiful because even to your point, you are already collecting financials on behalf of the business. You're already doing know your business, know your customer type of reporting. And all of that just actually streamlines our process even more because those documentations are already going to be ready. And that's a big part of kind of the timing and hurdle on our end when we start engaging with a client. So this is just really a partnership made in Bitcoin heaven, and we're really excited.
What we've discussed privately, it brings a smile to my face because as we were discovering each other's businesses, we realized like how perfect of a fit it was in terms of the puzzle pieces, and that very rarely happens in business. Oftentimes, it can be clunky, it can be a lot of overlap, a lot of gaps in place that have to be solved. And with us, it was very much like, oh, you guys do that as well? Perfect. Like that's exactly what we need to start the process.
I think we've tried to avoid saying the synergy buzzword, but there are sure a lot of synergies here between Acropolis and Timestamp, which let's discuss the fee model. So it's a success-based fee model, meaning that you're not putting a bunch of additional burden in terms of financial cost on these founders, which allows them to focus on building. It allows them to focus on the actual company itself. So could you discuss more on that end?
So this is, again, I think a decision that was made from first principles. I thought about how I wanted to build Timestamp and how I really wanted to properly align incentive structures. So when you think about us as a business, our main clients are the founders and the investors. The investors are happy when they have a lot of opportunities, they have a lot of information at hand, and they're able to go through the process and have a pleasant experience and full understanding of exactly what they're signing up for. And we provide that. And I think that is simple enough and what anyone would expect going through an investment process. Now, on the founder side, building all the tools is a great first step to really give founders the ultimate experience in raising capital. But it's also the way we structure our fees. So as you mentioned, we do a success-based fee model, which means ultimately that we only succeed when founders succeed, which really puts us out there in terms of our business, and we align ourselves fully with our founders. And that means our team is constantly thinking about the needs of our founders. We are fully on board with them every step of the way, like our business depends on it, because it absolutely does. And that was not by mistake. It was very intentional. And we believe that will align us well with founders going forward and give us the best chance to build something that founders really want.
The best businesses are the businesses in which the incentives are aligned. And it doesn't feel, a lot of times when you have a service that you need, you feel like it's something that you need, but you don't necessarily want it. It's not like the incentives aren't directly aligned. And we love that that's the way you charge at Timestamp, and that's what we do at Acropolis. So we charge BIPs on Bitcoin under custody so that as the Bitcoin grows, your treasury grows, our incentives are aligned, we take a higher fee. And I think I've said this before on podcasts, is that it's the best business model to be in, where we feel like everyone is able to win. So very much love the way that you structured that at Timestamp.
It's really another amazing piece of this partnership is timestamp, as you said, wins when the capital formation is a success, and Acropolis wins when the Bitcoin treasury is a success. So you're aligned for them to raise as much capital as is, justifiable and healthy for the business and to participate in that upside without adding any fixed overhead to obviously a business where any new fixed overhead is troublesome to founders and often hard to justify and get sign off from investors or the board, etc. And then boom, they move straight on through from their capital formation into Acropolis, where again, we are not adding overhead to the business. We're participating in a portion of the upside of their Bitcoin treasury. And so our job is to protect the Bitcoin in custody and to help grow that balance sheet. And we make money if Bitcoin goes up. And so, we're betting on Bitcoin alongside those founders. And so when I look back on my prior startups and if I were to be in the seat of a company that is doing something in Bitcoin, building something in Bitcoin, the two hardest things to do right now, probably the two biggest distractions from the operating business is, oh crap, I have to fundraise. And oh crap, I really need to treat this Bitcoin treasury thing with the care it deserves so that it doesn't become a distraction or jeopardize the operating business. And now, as a founder, because of this partnership, you can literally add Timestamp and Acropolis to your team without adding any overhead and basically outsource the capital formation function. Obviously, an enormous amount of collaboration with the founders and an enormous amount of collaboration that Acropolis does with the executive team. But to a certain degree, you need to get your focus back on your operating business, and Timestamp and Acropolis allow you to do that without adding any fixed overhead. If you're building in Bitcoin, this really has become a no-brainer. So we'll have to do our part to make sure we get the word out there. But anything you want to add to that before we move on?
No, I think you nailed it. I just actually have a couple questions for you guys, and I'm curious to hear your response. You guys work with companies in a wide range of sectors, but also at different stages. I'd be very curious from a 30,000-foot view, how does your approach differ when it comes to early stage companies versus some later stage companies when they think about building Bitcoin treasuries?
We put out this Bitcoin for Startups report about a month ago. And so this one is specifically tailored to how a company that is new, does not have a financial track record that would allow them to raise debt, does not have revenues that would allow them to service the debt, how they should think about a Bitcoin treasury as basically a company that just raised $1 million seed round. And so when it comes to the smaller companies, we really have to understand their runway, their burn rate, and make sure that they're only putting away into their Bitcoin treasury the kind of money that is last to touch. Because again, this really becomes an exercise in position sizing to make sure that they don't have to touch the capital when we're in a 30% drawdown, and then they end up having to explain to their investor base or their employees that now they're selling Bitcoin 30% less than when they receive the capital in cash. So that becomes a very sensitive operation, and that's where our Chief Investment Officer, Glenn Cameron, and his expertise really comes into play, is we have to do a deep, tailored financial analysis on each business that we work with, because we do work with startups all the way to literally a company that is 96 years old and has very predictable revenue, and has an existing corporate treasury that includes all sorts of instruments and vehicles, money market funds, bonds, cash. And so with a startup, you really have to make sure that you're keeping a keen eye on runway and keep creating kind of that cushion between, call it a 2-month to 3-month cushion in case, operating expenses were to expand without much, kind of in a spontaneous way due to some unforeseen expense or event. And then with the largest companies, Mason can speak to this. He was on the corporate treasury team at eBay. Those folks historically have looked at 500 ways at making 5%. And so maybe Mason can speak to how we work with the larger clients.
Yeah, I mean, when it comes to a large corporate treasury, I found, and I wasn't a treasury expert by any means, but I was on the treasury team at eBay. It's more about the counterparty risk and how do we diversify. And it sort of goes back to what we were discussing earlier in that, are you a legacy firm or are you a Bitcoin native firm? So are we having to go into the old architecture, dust off those cobwebs, get people online, sort of try to help change people's mind when they think about volatility, when they think about alternative assets, risky assets? I mean, all three of us on this call understand Bitcoin as, the least risky of all of the assets. But when you're going into, a giant treasury at an old firm, they just simply don't see the world that way. They don't understand what's going on. So oftentimes when we're working with these larger companies, it's a lot more work with the boards of directors, with the VPs, with the people who have long careers, 20, 30-year careers of doing not the opposite of what we tell them to do, because at the end of the day, a lot of the principles are the same. It's why we focus so much on custody, because that counterparty risk is the most important risk of them all. If you lose the Bitcoin, then nothing that you do in raising capital with Timestamp, nothing that you do in preserving the capital with Acropolis matters, because the capital isn't there. So there are some, dare I say, synergies, but it really is different when working with larger versus smaller companies.
Yeah, and I'll add to that. So Mason called out two really important things. One is custody and one is volatility. And I think that you could argue that these are the two most important differences between, say, a startup that's raising capital to add Bitcoin to its treasury versus an existing company that it has, predictable revenue. So these larger companies, they have done everything they can to rid volatility out of their business. And here they are understanding that they have to embrace this volatile asset class. And they're wondering, can I do this in a way that doesn't just take the last 20, 30 years of predictable revenues and predictable earnings estimates to my team and my investor base, and do it in a way that doesn't all of a sudden throw the business onto this, up and down cycle. And so position sizing becomes really important there. And obviously the stakeholder communications, investor relations side of the Acropolis offering, where we communicate, that Bitcoin is a volatile asset, but that if position sized correctly, should not become a distraction to the operating business. And so it becomes a big exercise in education. Whereas with the smaller client, a startup, that investor base is all about volatility. They understand that they might invest in a startup and it might disappear in 4 months, 5 months, because it's grow at all costs, it's go, go, go. Let's see if this thesis behind the business is even justifiable, if there's even a market demand. It's a very tested versus untested business. So you have different investor bases that need to be communicated with when it comes to the Bitcoin treasury strategy. And then again, with custody, so that's the volatility piece, with custody that Mason called out, a startup, that just raised 500,000 and wants to put 200,000 of it in Bitcoin, you could argue that they need best-in-class institutional grade custody less than a company that's parking 200 million in Bitcoin. Because what we've found, and this is a big part of the thesis at OnRamp and Acropolis, is that the bigger the Bitcoin position gets, the more valuable it is, the more having best-in-class custody becomes urgent to that business and that founding team. And so the bigger the company gets, the more we speak about custody and shareholder communications. The smaller the company is, it's more about financial analysis, tax and accounting treatment.
One more thing on that, from something I saw on Bitcoin X yesterday, is there's always a breaking point, and it applies for individuals and companies. There was a story of someone who bought a Cassius coin, but it was actually a Cassius bar, which is basically there's a Bitcoin public and private key on there. It's essentially the closest you can get to physical Bitcoin. It had 100 Bitcoins on there. He bought it in 2012 for $500. He said he held it all the way through Bitcoin breaking 10,000. Then this bar that's in his safe is worth $1 million. And he held on to it for this last cycle. Now the bar is worth $10 million. And he posted on the forum and he was like, guys, this is as much as I can handle. This is as high as I can go. And that same principle applies when it comes to a Bitcoin treasury, a personal treasury, a family, Bitcoin trust. There's a certain amount in which you go, all right, this is too dangerous for me to be leaving it on some form of single sig self-custody or a single exchange where they get hit by an asteroid or they go bankrupt or whatever happens, then it's gone. Just like the way someone could break into whoever this was, home and steal the Cassius bar. It applies to businesses as well.
Yeah, just want to touch on this because I think this is such an important point. Is just like an individual where you have Bitcoin now and you safeguard it in a certain way. My best advice to individuals is essentially pretend that it's worth 10 times more than it is now. And would you be safeguarding it the same way? And a lot of people say absolutely not. And so my next comment is, okay, so why are you not safeguarding it the way you think it should be safeguarded? If you think this is going where it's going and it's going to 10x, 100x, whatever you think it's going to do, you should essentially safeguard it as if it's already there, if it is within a reasonable budget for you, right? And that's, of course, the one caveat. Now, that goes, double, triple, 10 times for companies, right? Because when you talk about companies, now you have board members, you have investors, you have a lot of people that are essentially going to be emailing you, calling you, trying to get an understanding of exactly what the heck you're doing, particularly if they're not Bitcoin savvy. So I actually have a follow-up question for you guys. When I'm a founder and I'm thinking about Bitcoin Treasury, oftentimes I'm thinking about how much should I add to a Bitcoin Treasury? How much should I contribute to it regularly? But I'm not thinking necessarily about some of the other aspects. Can you talk about some of the other aspects that founders might not think about right away and why they're so important as part of a Bitcoin Treasury strategy?
Corporate communications is not something that only matters to large companies. If I'm going to join a startup, or if I'm working in a startup and then the CEO decides that he's going to take this recent capital raise and park it all in Bitcoin, and I'm not a believer in Bitcoin, or maybe I'm highly skeptical, I believe that I could believe that the risk of my equity value, my equity stake that I'm basically being rewarded in, as opposed to large compensation that I might get at a traditional corporate ladder type job, I might perceive that risk as untenable now. And if after the CEO or the C-suite decides to adopt a Bitcoin treasury, Bitcoin then drops 20%, I'm thinking in terms of my equity just dropped 20%. It might drop another 20% from here. What is going on? And so the corporate communication and education aspect, where Acropolis comes in and provides that support and kind of is the third party expert that can speak to Bitcoin as a risk off asset, that really is a preemptive solution. A lot of companies might feel that they don't need that, but then we're going to have that inevitable period of volatility and it will become a distraction in your operating business. You will lose talented individuals because you did not communicate and educate them on the strategy properly in advance. So the corporate communications is a huge piece. A lot of companies also don't have the tax and accounting folks that understand the unique properties of Bitcoin. And so there is a lot of value in our team either liaisoning with their existing in-house team or actually just outright servicing them when it comes to tax and accounting. So I would say that those are two often underappreciated aspects.
I probably sound like a broken record on this show, and this is episode 42 of the show. So, the answer to life, the universe, and everything, it seems like my answer is always custody and education. We have founders that come to us and firms that come to us and they know they need Bitcoin and they want Bitcoin and they want to raise money and they want to put cash that they have now and all these different things. They've been listening to our show and Bitcoin Treasuries with Tim Kotzman, and they're fully ready, but they don't focus enough on the custody piece. They go, oh, I was just planning on using Fidelity, which Fidelity is great. We respect Fidelity, and I'm a personal customer of Fidelity before I was 100% in Bitcoin. But at the end of the day, you just don't want to repeat the same mistakes that we've seen in Bitcoin over and over again, which is anytime you centralize the digital bearer instrument, things go wrong. whether it's Mt. Gox or FTX or BlockFi or Celsius, or just keep on going down the line. Again, custody and education seems to be the answer to everything when it comes to Bitcoin treasuries.
It gets particularly complicated when you're talking about corporate treasuries, right? Because you have so many different stakeholders involved, right? You have investors, board members, C-suite executives, employees, and if you don't really have a grasp on exactly how you're custodying it, who holds the keys, who has access to the keys, who has decision-making power, who can communicate this with all the different stakeholders, then you're really actually creating an issue rather than solving a problem, right? Because you might think that I'm buying some Bitcoin and I'm getting the benefits of having that as an asset that sits on the balance sheet. But if you're counteracting that with a lack of information and communication to all the different stakeholders, you might be shooting yourself in the foot.
Yeah, I mean, something as simple as user roles and permissions in a corporate C-suite for who has access to move the funds, what two-factor authentications are needed, what happens if the CFO leaves and we bring on another CFO, do we have a continuity plan in place? All of these things are totally irrelevant when you're holding your own personal Bitcoin, but all the importance in the world, especially if you have to get compliance and legal to sign off on the Bitcoin treasury strategy, that becomes the entire ball game. And it's actually a big reason why we've seen individual adoption of Bitcoin emerge and grow much faster than corporate adoption. So Arman, on that front, I'm sure our listeners are curious, is there a Bitcoin treasury strategy today at Timestamp? How do you all think about Bitcoin on the balance sheet?
Well, we think about it much the same way a lot of startups and founders that come to us think about it as well. And I'm actually looking forward for Timestamp itself to be working with Acropolis on our own Bitcoin treasury strategy. So our Bitcoin treasury strategy is very much the treasury strategy that we would recommend to our own founders. So we really, practice what we preach, and that's the route that we would go down ourselves. So we hope that this partnership can bring to light all the different aspects that founders have to think of when it comes to their capital stack on both capital formation and capital preservation, and really give them the tools to succeed, because ultimately there are already so many hurdles in front of founders that are building businesses that if we can play our part and solve this problem in terms of the capital stack, we give them the best chance to succeed in the marketplace. And that's ultimately the goal. We want more of these founders, more of these companies to succeed out there, because it's really the pioneers, the man in the arena that decides to build something despite all the risks associated with that. So if we at Timestamp and at Acropolis can do our part to help on the capital side of things, then they can be freed up to really focus on their business and growing what they believe and what we hope is a world-changing idea, a world-changing business. And hopefully that world-changing idea or that world-changing business is building on Bitcoin itself. So it all feeds back into itself, which is a wonderful part of being a part of this ecosystem.
Yeah, and we look forward to working with Timestamp on that. And obviously at Acropolis, we eat our own dog food, as they say in the world of startups. So we hold 100% of our capital in Bitcoin using our unique approach to custody, this multi-institution custody. And I'm curious, maybe last question for you here is if Timestamp has in the past, or maybe might look to in the future, doing something similar with your own service. So for example, would Timestamp ever consider posting its own capital raise on Timestamp? And why or why not? Because to some degree, you could say that that would maybe look like competing with the companies that are raising on your platform. But at the same time, it's basically 100% overlap of investors who know and understand and see the value of Timestamp. So curious if you've ever thought about using Timestamp for Timestamp's own capital formation.
So that is an excellent question. That's something that we have discussed and considered from the very beginning. I will say that the issue with potentially going down that route is a regulatory one more than one of desire. And it has to do with conflict of interest because it can be seen as putting investors at risk because you're basically putting an offering of timestamp on a platform that's meant to be a neutral intermediary between investors and founders. So there are some ways to do it, and we are considering it, but we've held off on doing anything of the sort as of now. But we'll see what that looks like in the future because I do think that is an interesting idea that is beneficial to timestamp, but also showcases really the full the full power of what it's like to raise on timestamp and also uh, partner with Acropolis and build a Bitcoin treasury. So we have considered it. We'll continue to consider it, but no plans of that as of now.
All right. Well, I know we're coming up on time here, so want to make sure we get the proper outro out. We're going to be doing an X Spaces together at some point this week, further discussing the partnership and publicizing it. If you're listening to the show, appreciate it. Please give us a like, maybe a comment, maybe comment something like episode 42 or something to show us that you made it this far. We appreciate the engagement. And then Arman, where can the people follow you on socials?
So they can find me on X or Twitter, Dr. Bitcoin MD, and I'm also on LinkedIn with my name, Arman McGorian, and they can go to our website, timestampfinancial.com, and learn about us, both for investors and for founders. Please feel free to reach out. I'm happy to answer any questions that you might have.
All right. Cheers, guys. Thanks for coming on.
Thanks, Arman.
Thank you.
Thanks for listening to this week's episode of the show. Quick reminder that New Foundations is for informational and entertainment purposes only, and nothing should be construed as investment, financial, or legal advice. Business owners, business operators, and those who are Bitcoin curious, let's connect. Visit AcropolisTreasury.com to learn more or to get in touch with our team.